Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 23rd of 2025. As we get started here in the holiday week, the chart pack will focus first on what we're seeing early on as signs of the holiday shopping season. We have the Sales Growth Index clearly in an advance position here. This is a diffusion line, so anything above 50 represents expansion. And you can see here, perhaps as we look at also the Red Book Index and retail sales on a year-over-year basis, that we have had consistent traction throughout the year so far. And what we're seeing here in this kind of like near-term data is the potential that we're tracking a little bit better than expected for the holiday shopping season. If we look at the Atlanta Fed numbers, this is for the third quarter of 2025. We've been talking to you about how GDP, or economic growth rather, has been tracking north or at 4%. You can see here that the latest estimates, and you can see that they've moved up consistently throughout the last couple of months on the preponderance of basically favorable data with some puts and takes, so on and so forth. But generally speaking, Atlanta Fed now looking for a final number. Remember, we get the headline announcement, and then we get two revisions that follow that. And so that final revision of third quarter data is expected to be around 4.2%. Also, from the Atlanta Fed, we have 12-month unit cost expectations, and you can see that those are sliding, which is good news. We look at this from a lot of different angles, and this is kind of a proxy for inflation, as you might expect, but this is the expectation, at least, of which does help to kind of inform us on, capital spending intentions and so on and so forth. Here we have the consensus GDP forecasts for U.S. and Europe. We've got to go back. We've got basically the tariff tantrum back here. And again, like we were just talking about, we've had estimates that have moved higher throughout the balance of the year. So this represents the United States. We're looking for the balance of the year about 1.9%. And as we look over in the Eurozone, looking about 1.3%. Again, much better than we had thought during the mid-spring season when we were dealing with the tariff announcements. Here we have in the group of 7 nations, we've got private sector deleveraging that's actually going on. It's not just a U.S. thing. This is global. You can see here, following the pandemic, that we've had a general deleveraging that has really eclipsed the point at which we were for basically the balance of the entire decade before the pandemic. However, that's now being replaced by debt at the government level, and you can see here very clearly that that's moving higher. Obviously, a lot of pandemic-related assistance here in the U.S. as well as other governments around the world. That has slowed down, but you can see the aggregate level moving higher at the same time that we're seeing kind of a general deleveraging in the private sector. Interesting chart that I saw. We've talked a lot about trade and the onshoring of manufacturing, and also with regard to China, a lot of the trade tensions there. And so China, we've seen a net degradation of trade between the U.S. and China. We had been looking at net positive trade with China with other trading partners. And again, China has a huge surplus of trade to the U.S., but a fairly large deficit of trade to the rest of the world. And what we find here, very interestingly enough, is that you've got Germans that are now importing more capital goods from China than they're sending to China, which is fairly amazing considering that Germany is basically the capital goods engine of Europe and is one of the primary sources of capital goods in the world. So this is a very interesting development. Again, it's kind of played out over a series of months here, but it is kind of getting worse in terms of a trade deficit. And what it's really prompting Germany and some other countries to do is to focus on investment in their domestic industries to make them more productive, to allow them to be able to generate more capacity, and so on and so forth, to combat this trend that they see as a threat to their security. So here's a quick update on foreign trade. This is both goods and services. This is a kind of a net balance of trade, if you will. So right now we're down at a $60 billion deficit in trade. That means that we are importing more than roughly $60 billion more than we're exporting. You can see that has been a lot worse. We were front running a lot of the tariffs here, and so that really was exacerbated. This number is probably not one that we should hang our hat on, because this is a microcosm of a much broader kind of trend likely here. But you can see that number, at least from a single month standpoint, and mind you, this is August data, so this is data that we're just now getting because of the government shutdown. So it is a little bit dated. So obviously we'll want to temper any kind of hard and fast conclusions until we get September, then obviously October as we get caught up here. But trend line is certainly less than what we've seen over the last few years. So more data that we're just now getting that's coming to us a little bit of a lag because of the shutdown here is U.S. factory orders, particularly transportation, which is important. We could see that a little less of a benefit this month, but it nevertheless was positive, which is positive in the general sense that despite some bit of slowing, that we're seeing consistent positive numbers in this regard. Core capital goods, this would be non-defense related capital goods orders, excluding aircraft, and that's up 0.4% for the month of August. Again, this is a bit more choppy because aircrafts and when we say aircrafts, let's be honest, we're talking about Boeing, that it can make these numbers rather kind of lumpy and inconsistent as we see here in the factory order numbers. But again, to have positive numbers, I think, is a little bit reassuring at a time where there is some uncertainty out there, and particularly amongst policy and trade. So we'll continue to watch this data and continue to hope that it will remain positive. Now, the probability of a rate cut in the coming month is actually going down. So last time we reported this to you, it was around 50%. Now it's getting close to 20%. So again, we've talked about this in many different respects. The Fed has a dual mandate for stable employment and stable prices, essentially, to kind of make that as easy to digest as possible. So they're fighting things on two different fronts right now, and inflation has been sticky because of the tariffs. Labor seems to have weakened. So lately we've heard more rhetoric from, I'll call it Fed speak, from the governors, the voting members that are out there on the lecture circuit and talking about the economy. They're really kind of is shifting their focus to the fact that employment is weak and using that as a lever, perhaps then to talk about why or the merits of having a rate decrease. Well, that rhetoric is a little bit more difficult now because it does appear that we're getting maybe stronger economic growth, as we just saw in the Atlanta GDP now figure for the third quarter. And we're maybe getting a little bit better retail sales. Employment, has certainly weakened, but prices are sticky. And so the preponderance of all of this information is now kind of leading us to conclude that the probability of getting that rate cut in December is going down almost by the day. Here we have some labor data. And again, this is coming to us. This is September data. And you can see here that non-farm payrolls were up about 119,000. And private non-farm payrolls were up about 97. This is actually a good number. You can see kind of this general downtrend with a couple of hiccups here. And then we have this kind of positive number. Of course, you just heard me say that I think labor is slowing down. Well, I mean, we see that in other data, like the duration of unemployment for those who are unemployed, and what we call kind of the U6 number, which is kind of like the long-term unemployed. We've had some changes in the workforce, and people that are either exiting or coming into the workforce. Uh, but just if you look at it again on a 1 month basis back in September, data was positive. Here we've got private payrolls excluding leisure, hospitality, education, and healthcare. So we're excluding some categories that have seen a lot of volatility in labor changes over the last several years. But going back to January 2023, we've had some degradation here for quite some time. So these two are to be taken together. 1 month we had, some positive changes in payrolls, but when we look at private payrolls and we exclude some of those categories that have been volatile, the net benefit has been negative. So unemployment rate now moving a little bit higher. We've got 4.4. You can see here that in this black line here, this is the aggregate, what they call the U3 uh, uh, unemployment rate. The kind of blue line here represents a 3-year moving average. You can see that that's kind of like tailing up. So this is another data point that I show you in evidence of kind of a weakening labor economy. And you can see, when you typically have these troughs and upticks here, it does has historically foreshadowed a recession. Not saying that that's what I'm expecting here, but it is a weaker environment. And this number here, and you look at the average hourly earnings continuing to go down, although it is much higher than pre-pandemic levels. But the rate of growth is definitely slowing here. But these two things being taken in tandem, is giving the Fed a little bit more cushion to lower rates if they want to, and I do think rates will come down. It's just the probabilities of broader cuts are certainly going down. Here's ADP. This is data that a little bit more real time, if you will. It's not the Bureau of Labor Statistics, not impacted by the shutdown here, but you can see a little bit of softening in labor. Home prices, we see now a very interesting dynamic that we have basically uh, new home prices are now lower than existing home prices. And, a lot of inputs are, kind of go into this. I mean, existing home prices are, maintained a little bit higher than usual because of low inventory, and many folks are locked in lower interest rate mortgages. And then on the new home side, we've got home builders that are building smaller homes. They're offering a lot of incentives to buy to move that inventory, and they're having their own issues with regard to borrowing costs and other types of constraints. So it's a very interesting dynamic that we have not seen in an extremely long period of time. Here we have the basically the percentage of builders that are reducing their prices. Is kind of going directly to the last slide. You can see that that's moved up consistently throughout this year. So a lot more discounts, builders trying to move inventory. Here we have the mortgage market. We can see here the Mortgage Bankers Association, the MBA 30-year mortgage rate holding steady about 6.3 effective rate on all the mortgages outstanding. This is something we've been watching for quite some time. Is still right around or maybe slightly above 4%. There's a lot of people that are locked into these lower interest rates on their mortgage, and they're really just not moving anywhere. Although you can see as more people are moving, that gradually this is eking higher. But if you look at this line, you can see here that although there's been some oscillation around midline, but you get past the you get past like mid 2022, then it really does look more like 6.5, 6.7%. And I think if you saw a 30-year fixed mortgage rate move down in, say, the 5.5% range, I think you'd see a rather noticeable uptick in kind of mobility and or refinancing activity. On this slide, we've got the Atlanta Fed Home Ownership Affordability Index, which we know is still near historic lows. Now we'll talk about some of the regional data. We've got the Philly Fed. The manufacturing index has certainly improved. However, it is still below zero. So what that means is that the Philly Fed, the manufacturing sector there in that particular Fed district, is still in a slight contraction. New orders similarly are in a contraction range now. They had been positive on balance for a while with a couple of whipsaws here in the data, but again, it just goes to show you that there are some areas of the country that are not doing as well as other areas. We look at the Kansas City Fed Composite Index. That is actually positive. So, location, 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 as I say, is very important on this type of data because there are certain industries that are maybe more impacted by tariffs, as would be probably the case in the Fed Philly district as opposed to Kansas City. Now, new orders, we have current new orders that have taken a leg down, so that's very consistent with the Philly Fed. But future expectations are looking brighter. So this is one of those kind of like green shoots that we're seeing in some of this data that kind of is leading us at this juncture to kind of expect an okay 2026 economic growth year. We've got existing home sales. We just had some home data for you before. You can see existing home sales are a little bit up. We've got more inventory on the market. Units, you can see here, still fairly subdued. So I'd say this is a labor market. This is a housing market that's still in quite a bit of a funk. Punctuated by that anomaly that we just looked at with new home prices being lower than existing home prices a few slides ago. This is the National Association of Home Builders Housing Market Index, and not too surprisingly, with some of the challenges that they've had in moving inventory off of their developments, that their sentiment index is fairly weak right now. Fed Financial Conditions Index. This is very interesting because we have seen since 2022 a consistently easing type situation on the part of financial institutions, and so we did see early on kind of a tightening of those conditions, looking back a year, but basically we've seen credit conditions on balance get a little bit easier. Got a chart here from Charlie Bolello, just reminding us about inflation. We've talked about the challenges for the Fed in managing inflation in a increased tariff environment. Here we have, basically you look at core CPI and all-in consumer price index CPI year over year. It's right about 3%. You can see that that's below not only the 2% that serves as the Fed's target. It's also below that level that we saw for the bulk of the last decade. Obviously here you can see the peak in headline consumer price index or consumer prices, just to be short, about 9.1% was the peak there. And core prices saw their peak around 6.6%. Office vacancies, just to revisit that subject, continue to move higher. We are trying to see the green shoots there on absorption, but we're just not seeing it yet. So vacancy rates on new office projects are really low. That's still putting a lid on, certainly a lid on new development. And it looks like that this is going to have a little bit longer to run yet. Here we have office delinquency rates for mortgages that have been converted into CMBS or commercial mortgage-backed securities. You can see that, not too surprisingly, with those vacancy rates, we're seeing this number move really considerably higher in a relatively short period of time, and 11.8% represents a record high in those delinquencies. So looking at credit in other areas, consumer related here, we've talked about this over the last month or so. Credit card balances. Now, we were hoping to see kind of a little bit of a tick down and maybe evidence of a trough, or excuse me, a peak. That's not the case. Credit card delinquencies, as defined by being 90 days delinquent on a payment, 12.4%. And then you got to go back quite a ways, basically 2010, kind of after the global financial crisis, to see levels that were that high. Student loans, a little bit more of an anomaly here because we have the payment moratorium. And then obviously when those payments resumed, then that spiked. Auto loans, again, I think these are two categories that might have peaked. Auto loan delinquencies on balance, and mortgages. Now, sliding over here, we've got auto loans for subprime borrowers. You can see here, if you have good credit and you're a prime borrower, those delinquency rates are just hanging in there, right? They're not really moving that much. It's just the people with poor credit, again, to this notion of this K-shaped economy, where people at the upper income cohorts are doing okay, they feel fine about the circumstances. It's the people that are in those lower income cohorts that are really feeling the stress and feel completely differently. Here we have a fund manager survey from B of A, kind of bringing us current with what the perceived risks are out there. You can see here the risk of us being in an artificial intelligence kind of a stock bubble, if you will, has really moved a lot higher. September, you can see here is maybe 10, 12%. Now it's 45%. So this is the big burr under the saddle right now. And honestly, this makes total sense because you can correlate it with the activity in the stock market as of late. Now we have seen, as we'll see in a second, a 10% correction in technology stocks. We've seen, basically a 5% correction in the broader market. Period. And a lot of it's driven by this fear. And you can see, bond yields moving in a disorderly manner is certainly up there. Inflation, not as much. I think we're a little bit less concerned with that. And then you've got these other issues here. U.S. dollar, not nearly as much of a potential perceived risk as it was just a few months ago. Here we have the S&P 500. You can see here this latest leg down. We have now hit our 100-day moving average, which honestly is something that we hadn't done in a while. In fact, we haven't had a 5% correction essentially since April, which is very rare. I mean, and we've gone up in a fairly, almost like an orderly manner. I mean, this is about as straight a line as you can get. But let's look at the part of the market that really has driven this, and that's the technology. This is the S&P 500 technology sub-index. You can see, how it's moved. Obviously down. You can see that drawdown, as I just mentioned in the prior slide, about 10% already in a relatively short period of time for that tech sector drawdown. So this is a slide to all those people that just have loved, NVIDIA, Tesla, Meta, and it's a very noisy chart, but it's taking the Mag 7 really and kind of breaking it up into its near-term activities. And you can see here, for all those people that, enjoy, the ride when it's going up, you got to take the medicine when it's going down. And you can see Meta really since its demarcation point at the end of last month. I mean, Meta's down 20%. right? And then Tesla's down 13. Nvidia, the darling of the stock market, down 12.4%. These are hard numbers to digest. Even the stalwarts of Microsoft and Amazon are down a bit, and only Google is up for the month to date. But just really to highlight kind of like why we have the philosophy that we do. We're not trying to chase returns, because when you get too cute about things, then you have episodes like this happen, and it makes you have to generate more return to get out of those doldrums, especially if you have relatively high concentrations in these. Here we have the difference between consumer staples and discretionary. Again, I would almost kind of take this back to the K economy here too, because I mean, you've got consumer discretionary, when you're talking about the upper income cohorts that have money to spend, the top 10% accounts for about 50% of overall consumption. Those people are feeling good, so they're continuing to spend, and that's translating into, at least on a relative basis, better performance for the consumer discretionary stocks. Now, on the other hand, you've got the staples. These are, in many cases, the higher dividend players are ones that are, that have lower growth rates, but they have high cash flow. They're high quality companies, but they're just not catching a bid right now because of this kind of relative euphoria in these consumption stocks versus the staples. And you think of staples, just think of like Kimberly Clark, right? I mean, tissues, toilet paper, those types of things, toothpaste, Procter and Gamble, so on and so forth, versus a whole bevy of discretionary firms. So again, K-shaped economy, we've seen more divergence here as of late, and again, we'll have to monitor where it goes. Here we have another dissection of the S&P 500. This is once again looking at the cap-weighted index versus the equal-weighted index. And when I say cap weight, I mean capitalization weighted. That just means the largest companies by market capitalization are going to have an outsized influence on the index, and that is the S&P 500 as it's reported. It's the cap-weighted index. So now what this is telling us is that the equal weighted index is grossly underperforming the cap weighted index, and to the tune of about 25%. And that's a deviation that it almost never exists. It's intensely out of line with the trend line. Not to say that we haven't been there before 2000, that this was back in the tech bubble. But it looks very similar to that, in fact, just in terms of its relative deviation. But you can see here that over time, the equal weights do battle back. And so this is like going back to, some of those high quality companies, the cash flow companies, the ones that are not tech, that maybe haven't felt nearly as sexy lately. There's almost always, you see here, going back to the 70s, there's always a bounce back in relative terms for the broader market. Here we have price attribution. We can see here that basically, lately what we've seen is basically multiples contract. Now, what's interesting is that earnings in the blue line here continue to move higher, and that's really what's propelled this market. Basically, if you look at going back to January and bring us current, like the price to earnings multiples maybe have gone up like 1.5%, maybe 2%, right? But earnings have been the driver of equity market performance to date. Here we have volatility. We've been talking about low volatility for a long period of time. Well, we're getting volatility again, and this is a good thing. So for those of you who know how much time we spend looking at opportunities in the structured note arena when volatility picks up, well, we're definitely looking at things now. We'll be certainly over the next week looking to deploy some investments now that we're seeing volatility pick up to levels that we haven't seen since the tariff tantrum just nary a few months ago. A quick look here at the Treasury curve. Again, mostly upward sloping. We do have kind of a sticky FOMC, so short-term overnight rates are higher than looking out into the next couple of years. But then if you you go out 10 and 30 years, particularly between the 10 and 30-year mark, it really does flatten out quite a bit. But there certainly is an upward sloping yield curve in existence. We're talking about the bond market. Well, actually, we're talking about the mortgage market and how there's a lot of mortgages that are still below 4%. Well, this is more evidence of kind of the legacy of that really low yielding world that we lived in before 2022. And you can still see here very clearly that you've got basically almost 90% of bonds in the world have a yield below 5%. And even 4%, you were talking about 2/3 of the bonds, global bonds outstanding, have yields less than 4%. So in a higher yielding world, these are obviously less competitive. So, from a market pricing standpoint, they're going to be adjusted because these yields are lower. They're going to have to adjust for it in pricing to be consistent with, current yields for the type of product and for the type of credit. Here we have option adjusted spreads. So just think of this as kind of like credit spreads for high yield corporate bonds. And one thing that we've noticed lately, those spreads have moved higher. So anytime you see kind of spreads moving higher, that's an indication as it's being priced into these types of bonds of the perception of increased risk. So anytime you perceive maybe the economy is going to slow down, you're generally going to see an uptick in credit spreads here. Here's another chart of on looking at credit, but this is really more from the issuer's point of view. You've got bank loans year over year. So like we saw earlier in the chart back, we've had a net loosening of standards over the really the last year to 2 years, and you can see that manifest here in U.S. bank loans, and similarly you can see an expansion of bank loans in the euro area as well. Generally something that you're not going to see if you feel like there's a risk in the market, which does fly in the face of the chart that we just looked at with the expanding credit spreads. But I'll submit that on that last chart, credit spreads have been too low for the environment that we're in with the increased policy and trade uncertainty that we have relative to a year ago. Now some updates on commodities to kind of bring you current. We've been talking about beef prices have been a huge issue, but they've come down actually quite a bit in just the last month. You can see cattle futures here moving down. You see cotton. This is a much longer scale, but you can see general downtrend in cotton. And then here corn, which does catch a bit of a bid because of its use in fuels. But if you look at corn, just on balance, we've got corn actually moving a little bit higher as of late. Cocoa, we see that moving down as well. Soybean oil moving down, although we've had a little bit of an uptick. Some of these have been kind of at the heart of some of the ag-related trade uncertainties from this current year. But you can see prices moving in kind of almost measured directions. The last slide here is a chart on Bitcoin. Again, very similar to the chart that I showed you on all the Mag 7 stocks. And you can just see here, 120 to 80. Basically you're losing a third of your value in a really short period of time. So, again, I don't have a problem with Bitcoin as a very modest diversifier, but it comes with a lot of risk and a lot of price volatility. And if you're going to be an investor in Bitcoin, you have to, just understand that volatility and internalize it, because it will come. That's all the charts that we have this week. Hope you've enjoyed the chart pack, and have a terrific Thanksgiving week. If you're traveling, be safe. If you're with family, I hope you enjoy that blessing, and we'll talk to you again soon. Take care.